everybody. This is Ellman, the Blue Collar Investor, and welcome to BCI podcast number 5, titled Improper Timing About Covered Call Trades Can Lead to Lost Opportunities. In addition to knowing which stock and option to buy, it's critical to also know when to execute our trades. And this podcast will go into a specific example sent to me by Joanna on 7/20/2018, which highlights the significance of timing our trades. So prior to the 20th of July 2018, Joanna purchased 3 securities on the same day. They were Health Equity Inc., ticker symbol HQY, Copart Inc., ticker symbol CPRT, and HD Supply Holdings, ticker HDS. Now, instead of selling the covered call right away when the shares were purchased, Joanna decided to wait to see if the shares appreciated and then sell the call and generate even more income. But no options were sold as share appreciation was waiting in the wings. At least that's what Joanna was hoping for. Now, what happened, of course, was the share price on all 3 of the securities declined immediately. Now, they did quickly recover. So for those of you familiar with the exit strategies in the BCI methodology, the first thing that probably comes to your mind is that this was an opportunity to hit a double. We can envision that classic V-shaped pattern, and I'll show you these in charts very shortly, where the price of the stock declines, we buy back the call option, and then the price of the stock reaccelerates, and we resell the same options. So 2 income streams in the same month with the same cash, as we visualize the classic V-shaped pattern. Now, as an example, HQY was purchased at $82. Very shortly after that, it dropped to $73 and then recovered right back to $82. This is a classic situation where we should institute our hitting a double strategy. So let's look at the price charts on all 3 of these securities. And you could see here with this classic V-shaped pattern that the price of the stock declined dramatically and then accelerated right back up. It didn't take very long for it to change, but it was a lost opportunity. Had the option been sold right here, we could have bought it back right here and then resold it here, hitting a double, but that wasn't done. Let's take a look at the other 2 charts. You could see the same exact situation, the same exact pattern with that classic V-shaped pattern. These are situations that will put cash in our pockets, and we must be prepared to take advantage of all of these situations. HDS, same thing. Price of the stock declined and then went back up. And when it went back up, we could have written a second call option right about here. Of course, that didn't happen. So every situation where we make a mistake, if we learn from it, then it was well worth making that mistake because we know we're not going to do it again. So what are the lost opportunities in this situation? Well, first of all, had the call option be written initially when shares were originally purchased, we would have gotten the highest time value premium because with theta, or time value erosion, the amount of time value declines for every passing calendar day. So that was one lost opportunity to generate the highest time value profit. The second opportunity lost was not being able to utilize our hitting a double exit strategy. We could have had 2 income streams in the same month with the same cash investment on the same stock. Now here's a chart showing your classic hitting a double strategy. So initially you see here that a stock was purchased at $30.83 and the call was sold at 95 cents. Now what happens? Boom, the price of the stock declines. Using the 20%, 10% guidelines, we bought back the option at 15 cents down here at the bottom of the V. Then what happens? The price recovered and we resold that option at 70 cents. So let's have a look at how we did here. We generated $95 a contract initially with the covered call. Then we had a net credit of $55 a contract by hitting a double. We had a credit of 70 minus the cost to close, which was 15 cents. That's a net credit of $55 a contract for about maybe 3 or 4 minutes worth of work. Is it worth it? I think so. Now, if you have a look, interestingly, we didn't do anything about it, but sometimes there's even a second opportunity to hit a double as you see share price declining and rebounding. But that was later in the contract when time value is really falling off a cliff. So late in the contract, it's very difficult to hit a double, but I'm showing you this simply because I want to point out that once we initiate an exit strategy, that doesn't mean we're done. There may be an opportunity to initiate even a second exit strategy in the same contract line. So let's summarize now. When we enter a covered call trade, the share purchase and the option sale should be done simultaneously, whether we're legging in or using a buy-right combination form. It doesn't matter. We know that we're generating the returns that meet our goal, and therefore we should take advantage of it, not hope that share price goes higher, because it could just as easily go lower. So that's the first thing. The second lost opportunity is that using the 20%, 10% guidelines after the initial covered call trade is initiated can create opportunities to generate more than one income stream in the same month with the same stock and cash investment. So we must be able to take advantage of these situations, and that's why preparation along with proper timing of our trades will allow us to achieve the highest possible levels of returns. So I want to thank everybody for taking the time to listen to this podcast. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.